whoever attending this webinar, whether you work in a bank or whether you are an entrepreneur or a finance manager or a chartered accountant or a cost accountant, okay, please take this principle to your heart, to your mind, and try to teach this to as many entrepreneurs as possible, because several businesses fail because of not understanding this principle. Okay, now listen. I said money for business can be raised from the owners, we call it as equity. It can be raised from outsiders, we call it as liabilities. And this liability can be short-term liability, and these short-term liability can be used for creating assets. They are called as short-term assets. But here if you look at short-term assets are greater than short-term liabilities, it means some portion of short-term assets are funded by long-term funds. I call them as long-term liabilities and equity. So this gives rise to the understanding that equity, the money contributed by the owner, is always long-term, and other long-term liabilities. Liabilities means repayable. So it can be a term loan, it can be a debenture. Okay, right. So if you look at the composition here, short-term assets are created using an entire portion of short-term liabilities and some portion of long-term funds, I call it. So you still have some more long-term funds which can be used for creating long-term assets. Now comes the fund utilization principle. If you are raising short-term funds, you can use it for creating short-term assets. It is good. If you are raising long-term funds, you can use it for creating long-term assets. That is also good. If you are raising long-term funds, you can use a portion of long-term funds for creating short-term assets. That is considered as ideal. But one thing that should never ever happen in any business is never ever use short-term funds for creating long-term assets. Never ever use short-term funds for creating long-term assets. Why do I say that? Short-term funds are raised with a promise that you will repay within 1 year. And if you want to repay within 1 year, you should have invested that money in short-term assets, because only those assets can be converted into cash within a period of 1 year, so that you can use that cash to pay back the short-term liability. On the other side, if you use the short-term liability on creating long-term assets, by very name, by very nature, they are long-term assets. It means those are all the assets which cannot be converted into cash within a period of 1 year. So you borrowed with a promise you will repay within 1 year. So when the due date approach, if you look back, you will not have short-term assets. What you will have is only long-term assets. Long-term assets by very nature, by very definition, they cannot be converted into cash within a period of 1 year. Then you will carry sorry figure, or you will carry sorry face with your lender. Imagine that short-term liability, that short-term fund was given by a banker in the form of a cash credit or overdraft. And when they demands the repayment, and if you don't have a matching short-term assets because you have already used that money in long-term assets, what's your position? You will not be able to sell that long-term asset. But this lender, the banker who gave you that cash credit, who gave you that overdraft, will hardly wait for 90 days. 90th day they will classify the account as non-performing asset, and they will go for legal recovery measures, and that becomes the beginning of end of a business. Okay, so understand, diverting the short-term funds for long-term purpose is suicidal. Most of the business, they do not realize this. They think all money are same, but short-term money have very high pressure because they have to be settled in the short-term period. But long-term money, they are cool because you have to settle them over a period of time only. Just imagine, you take a home loan, you have to pay over a period of 20 years. Your obligation will also be manageable. But for that entire home loan amount, if you go and take an overdraft, imagine the kind of pressure. Will you be able to settle that entire home loan amount within a period of 1 year? It will not happen, right? So if at all you raise an overdraft equivalent to home loan amount, and if you put that in constructing a house, it means you are not constructing a house, you are constructing something else which I don't want to mention, because it's going to put you in trouble. It will give you sleepless nights. Okay, so never ever do this. Let me give some numbers so that we can understand it better. I've raised short-term funds of 100 million, and I've used that funds to create short-term assets of 70 million only. So here comes the problem. I've raised short-term funds of 100 million, but the short-term assets what I have created out of it is only 70 million. So the question is, what happened to that remaining 30 million? And the answer is very obvious. It is not in short-term assets. They are in long-term assets. They are in long-term assets. So what I've done here, I've diverted the short-term funds of 30 million for long-term assets. And I've also raised some long-term funds of 70 million, which I've used for creating long-term assets of 70 million. So my total both sides are 170 million. But here what happened is I've raised 100 million, of which I have spent only 70 million for short-term purpose. Then I did that blunder, unpardonable mistake of diverting the short-term funds for long-term purpose, 30 million. This is going to put this business in serious trouble, because the lender, whoever have given that 30 million, they will come and ask for the payment within period of 1 year, and for paying them I don't have short-term assets, because the existing short-term assets is only 70 million. For that there is a corresponding obligation of 70 million, whereas for the remaining obligation of 30 million I don't have short-term assets. What I have is only long-term assets. Long-term assets I cannot sell just like that. It will take its own time, and those lenders will not wait till I settle my long-term assets or till I sell my long-term assets. Okay, that's where the problem starts, because bankers are permitted to wait only for 90 days. Then they have to go for legal enforcement. If it is a supplier's money, probably he'll give you 2 or 3 calls, then he'll go for legal enforcement. That's where the problem starts. Okay. So here there is a diversion of 30 million, and this 70 million they have used for a long-term purpose only. That's okay, but the blunder, the mistake, the sin what was committed here is diversion of 30 million short-term funds for long-term purpose.
How to read balance sheet, how to perform financial analysis using ratios, cash flows, fund flows, how to do financial modeling for bank loan purposes using CMA report and cash budget, how to assess credit facilities like cash credit, overdraft, letter of credit, bank guarantee, term loan. If these are all the areas you wish to learn and achieve mastery, we can help you out. Our comprehensive course, Credit and Financial Analysis Mastery, is for you. To know more details, just come and see FAMB. I'll share the details with you.